You're listening to the Option Alpha podcast from OptionAlpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at OptionAlpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again from OptionAlpha.com, working every single week to make this the most popular investing podcast offered online because it's based on one thing and one thing only, and that's helping you guys make smarter trades. And so again, thank you so much for tuning in today. On today's show, we're going to be going through another case study in adjusting trades. And in this case, we're not necessarily talking about trades that we were assigned, like what we went through in show number 149, but we're going to be talking about how we adjusted multiple short straddles in EWZ as the stock was taking off from recent lows. So again, a really good case study, another example of how we would go through the process while we're walking through the trade, kind of in this timeline for you guys, so that hopefully it helps you guys understand the process and how to make smart trades, how to be more confident in adjusting positions and kind of sticking with it throughout the entire timeline. So again, as always, if you guys have any questions or want to see a history of things as we go through them, head on over to the show notes page at optionalpha.com/show 151. Again, that's just the number 151, optionalpha.com/show 151. Now, I will point out though that another case study that you might want to take a look at that's related to this, if you want to stick on the topic of EWZ, is the case study where we were looking at our short put assignment in EWZ that actually happened right before we got into this trade, which we had to adjust multiple times. So it's kind of interesting. We basically got into a trade in EWZ a while back. We did a case study on that in show number 142, where we were assigned short put options, how we dealt with that, very similar to how we were assigned on the most recent podcast we did on assignment, which is show number 149. But then right after we were done with that and released the case study for EWZ, then we got dealt this hand where we did some short straddles again in EWZ and it went completely against us. We had to adjust those multiple times, which is what we're going to talk about today. It's just kind of funny that we had those back to back. So in either case, I'm trying to give you guys as much information as possible, as much transparency as possible to show you how we would walk through different scenarios during different market environments. But again, a related one that you can go back and listen to if you haven't already is show number 142, which was our short put option assignment case study in EWZ. All right, so again, today we're going to be going through EWZ, and specifically we're going to be talking about three sets that combine into two sets of short straddles in EWZ. Now, this again is sometimes a little bit challenging to do on podcast. So we have video versions of this that we've sent out to members when we actually closed out of the original positions, and we'll link those up in the show notes so you can see those. But in either case, what I want to do today is walk through the entire trading case study from start to finish, all of the positions that were involved, when things happen, so you can go back and look at charts and kind of double check it. But hopefully I can walk through it and give you guys as much valuable information as possible. So when did all this start? Well, this all actually started with our very first position for October in EWZ, which was entered into back on 9/18. So on September 18th, we entered into our first position in EWZ, which was selling the 33 straddle for October expiration. Now, that means that this position took a really long time to kind of work itself out, but the original position was entered into on 9/18. Now, if you look at EWZ on the chart at 9/18, what you'll notice is that EWZ had been through a little bit of a down move, and in fact had come from highs around 38 all the way down to a low of around 31-ish. And so it had just started to rally off of the bottom, not necessarily breaking out by any stretch, but has definitely been off the lows for a day or two on 9/18. And at that same time, implied volatility was insanely elevated. So we had really high implied volatility over the 90th percentile. So naturally, what we try to do is sell options during that time period and collect as much premium as possible. Now, this was also made evident by the fact that we could collect at that time for October expiration some pretty good premium. About $390 was the initial credit that we took in on the first set of straddles that we sold in EWZ. Now, as always, we do these in very small pairs or very small laddered entries. So the first set we did was just 2 contracts, again, selling the 33 call and the 33 put for $3.90. Now, we held on to that, obviously. That was our first entry for October expiration. We still had plenty of time until October expiration came. So what we decided to do then was to add another laddered entry set for EWZ, selling again the 33 straddles, but now this time it was a couple days later and we decided to sell November expiration. So this is always, again, another thing that we try to do is as we get closer to the expiration dates, we don't want to trade, say, inside 20 days as a general rule of thumb, or anything close to inside 20 days, maybe 25-ish days. We want to start going out further in time and selling more monthly type contracts. So when we got to 9/24, so about a week or so later, on 9/24, we saw EWZ rally up a little bit and then kind of fall back. And again, implied volatility was still pretty high at this point. So EWZ had rallied up to 34 and then had fallen back down to 33. And so we thought to ourselves, okay, well, look, the premium that we can get selling EWZ in November now is insanely high because implied volatility is still very high. So why not spread our trade out over 2 different contract months? We have October 33 straddles and we have November 33 straddles. So that's what we did. We entered another set of 2. So 2 33 November straddles, but this time we collected $5.53 for these straddles. So you can see, trading a little bit further out, we were able to collect a massively higher premium for these straddles for October expiration. And so the idea here is that, look, even if implied volatility is high, we're collecting $5+ in premium here. That gives us about an $11 range for this thing to move and still make money between now and expiration. So we had a good range that EWZ could go up by $5.50 or down by $5.50 and still make money by November expiration. Well, what continued to happen? Well, we continue to enter slow laddered positions, and on 10/2, so again, just another week or so later, we entered another set of laddered entries in EWZ, selling the 35 straddles. So now EWZ had started to move higher just a little bit, and by 10/2 had pretty much gapped higher to around 35 or so. So had a big gap up. It was clearly off the lows, but yet implied volatility still had not moved just yet. So implied volatility was a little bit lower, but it was still around the 85th percentile or so. And so as a result, implied volatility was still good. Option premium was still high. So we entered another laddered entry in EWZ, selling the 35 straddles. Again, another set of 2 contracts. Keep it all very systematic, very mechanical. And we collected $5.33 for those contracts. So a couple days later, a little bit of time decay, we're still collecting plus $5 credits for selling these straddles. So at this point now, we've pretty much built up as about as big of a position as I probably wanted in EWZ, unless things went really good and it just traded sideways, right? But that, of course, never happens. It never does exactly what you think it's going to do. So we had this position in EWZ and we started to hold firm. We've got 3 of these straddles kind of outstanding, 3 sets of 2 contracts each, 1 set in October, 2 different sets in November. And we feel pretty good about it. And I still would say that I felt pretty good about the position and would do it all over again even today. So what happened after that? Well, literally the day after our entry into the 35 set of straddles, which again was on 10/2, EWZ then started to rally really strong, really fast. In fact, going through multiple gaps higher on its way to basically a high around 40. So it really took a long time for EWZ to bottom, but then when it started to move higher, it moved higher real quick. In a matter of like a week and a half, it went from 35 to 40, which is a pretty decent move for a large ETF like this. And so what happened as a result of this? Well, as a result of this, we saw implied volatility drop back down to around the 50th IV rank. So still elevated compared to most things, but absolutely lower than where we were at the time. Now, the problem is that with the stock trading around 40 or so, and us selling most of our premium at the 33 strike and the 35 strike, we were just outside of our break-even point on EWZ, and it had moved about that $5 expected range, or just a little bit above it for the 33 straddles, to the point at which when we got to October expiration, we could not do anything with the 33 straddles that we had. So the problem became, okay, what do we do with this original set of 33 straddles that we can't do anything with right now? How do we mitigate this risk, right? Well, the first thing we always try to tell people is if you can roll for a credit, roll for a credit. And that's what we decided to do. So on 10/8, we were able to roll our 33 straddles from October. Remember, this is the original set of 2 contracts. We rolled those contracts to November using a double diagonal order. Now again, don't get confused on the terminology. All a double diagonal order means is close one set of straddles in one contract month and reopen the exact same position in the next contract month. So we closed October, reopened November, and we took in a total credit of 117 on this roll. Now this is crazy because most of the time when a stock is this far in the money and this far out of your profit zone, you're not going to be able to take in a pretty decent credit like that. But because implied volatility at this time on 10/8 was still pretty high, and we still saw, pretty decent levels of implied volatility across option premium, we were able to roll these contracts out to November expiration for a $1.17 credit. Now at this point, again, just to catch up on where we're at, originally we had a set of 2 contracts in October and then 2 different sets of contracts in November. Now we have rolled our original pair of 2 33 straddles out to October. So now at this point, we're sitting with 4 straddles at 33 in November, and we're sitting with 2 straddles at 35 in November. Okay, so we're combining and kind of mushing these 2 together, all in the same contract month of November. And again, the goal was to roll the contracts that we had in October out to November to give ourselves more time to see some sort of cyclicality play out, right? This is what we always talk about, is that, when the market has such a huge move and goes parabolic to some degree, we want to see if this thing has legs. And I most of the time would say that it doesn't. And we're going to see some sort of ebb and flow in the market. The market's going to rise and it's going to pull back and then rise again. We just needed any sort of pullback to give ourselves an opportunity to make some money on this trade. So rolling and extending the duration allowed us that extra time. And even more so than that, we were able to add to our credits on the original trades that we had so that widened our break-even point on the strangles. On the straddles. So remember, our original credits were $3.90, $5.53, $5.33. Now we're adding another $1.17. So we're just kind of slowly widening these break-even points as we go out in time. Okay. So at this point now, like I said, we've rolled contracts right before October expiration, and now we're sitting with 33 and 35 straddles in November. So what happens from here? Well, we basically sit on our hands the entire month of October and into November. So during the entire month of October and into November, EWZ actually rallied and continued to move higher, pretty much no days down, no significant days moving down, and rallied all the way up to a peak on 11/2 of $41.50, basically very close to $42, I think, intraday. So at this point now, most people freak out. And again, I'll reference back and say this is where I got literally the most number of emails on this position by far that I would have gotten in this entire time period. All of the talk about, that's it, I'm done, like this is where people threw in the towel, happens to be also the top in EWZ for the last 2.5 months. So that day on 11/2 happens to be the top in EWZ for the last 2.5 months. No coincidence to me that was the day that I got most of the hate mail and email activity from people. Not saying you guys are mean and stuff, but just people get frustrated with it, and I get that. And they send all these emails about they're quitting the position, they can't handle it anymore, it keeps going against us, why aren't we doing anything, yada, 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 yada. Now the thought process on that point, at that point was, well, look, we're going to give this thing as much time as we need to, right? All of October to come back around, and it hasn't come back around yet. At the same time, EWZ was also flashing some technical overbought signs. So these overbought signals were suggesting to us, hey, look, the pace at which EWZ is going up is definitely too fast for its own good. It's going to either stall and trade sideways or reverse and go lower. Now, we don't know which it's going to do, if it's going to reverse, and that most people think when they get a technical sell signal that it means it's going to do a V-shaped reversal, but that's almost never the case. It's usually going to trade sideways or slow the pace of ascent as it starts to roll over and kind of fold. So again, on 11/2 now, the stock has made these huge, huge, huge moves higher. So what did we decide to do? Well, on 11.2, implied volatility was still pretty good in EWZ. In fact, at that point, implied volatility was actually a little bit higher than when we had originally rolled contracts out from October to November. So implied volatility still pretty high at this point, definitely above the 50th IV percentile, around like 55, 56-ish. So really high implied volatility. So what did we decide to do? Well, we decided to roll these contracts again out to the next expiration period. And I'm telling you, like, this is the craziest thing. Like, every time I do this, and this is now the second roll that would have happened in EWZ, rolling contracts from one expiration to the next. I mean, like, everyone comes in and they just like email like they're quitting on the position. Like, Kirk, why are we rolling? Why do we continue to do this? We're just extending the loss. This is never going to work. Like, all of that stuff happens. But what I always get back down to, like, me personally, is if I can control the position size and I know markets are cyclical, then if I can roll for a credit and extend my timeline, I'll wait it out until the market becomes what I know it's going to become, which is cyclical. I know that not every rally up is going to stay higher forever. I know that not every drop lower is going to stay lower forever. We're going to have some sort of cyclicality and bouncing around. And so if I can keep my position size small enough to weather out those storms, those high and low waves, then I know it's going to come back around and I'm either going to A, reduce risk and have a smaller loss, or B, turn the whole position around. Okay. And that's what I ultimately ended up doing here with EWZ. So in this case, what we did here is on 11.2, we again rolled our straddles to the next expiration month out to December. We again used the double diagonal orders, which is just a fancy way of saying we closed straddles in November and re-entered the exact same straddles in December for the exact same strike prices and added those in December for higher credits. The 35 centered straddles in November, which we only had 2 contracts, we rolled out to December for an $88 credit overall. So the difference between closing out the Novembers and entering the Decembers was $88 per contract. The 33 centered straddles that we had in November, and remember, we had 4 of these at this point, 2 that were rolled from October and 2 that were kind of the originals from November. Those 4 centered 33 straddles for November, we again rolled out to December for a $51 credit each. So we are again still collecting credits, sticking with the exact system that I've kind of laid out and put out on the website, my thought process on doing this. I'm rolling for credits, extending duration, but not increasing my position size, and have yet to go inverted, which is kind of crazy in this instance, right? That inversion's not, to me, the always default de facto move. Had we not been able to roll for credits, then we would have maybe looked at going inverted to reduce risk. But in this case, we were still able to roll the position out to December expiration and not have to go inverted. Remember, we're selling 33 straddles and the stock is now trading basically like at 42 and around that zone. I mean, it's almost $10 out from our short straddle strike price. But during this entire process, we've collected massive, massive premiums along the way. So as we continue to move out and go further out, the 33 straddles that we sold have now collected a blended credit. So the credit on all of the positions for 33 on a per contract basis was $5.81. So by rolling out all of these 33 straddles, we basically have collected a total of $5.81 on average per contract. Now that's really important, and you just have to track the summation of all of these credits and debits, right? So the original 33 straddles we sold for $3.90, then we added November's for $5.33, we rolled October to November for $1.17, then we rolled again from November to December for $51. We're just totaling all of these up and then averaging them across all the contracts. So for the 33 straddles, we collected an average of $5.81 in premium. Now, what's cool about this is that moves our break-even point out to $38.81. So we add that credit to the strike price of our short straddles, which is how you calculate the break-even on a short straddle, and that moves our break-even point out to $38.81 on those straddles. Now, the 35 straddles, we've collected a total of $6.21 on. So the 35 straddles have a break-even price of $41.21. So now you can see, even though our contracts were in the money and deep in the money, right? Because we were selling contracts that were below where the market was trading. Because of the premium that we collected from selling the options during high implied volatility, we were able to move those break-even points much, much closer to where the stock was trading at the time. So at the time that we did these rolls, again, the stock was trading up around 41.5, close to 42, and our break-even points were 41.21 and 38.81. So not too far off. In fact, just a little move lower, little bit of cyclicality, and we're right back in the game. So what ended up happening? Well, right after we rolled those contracts, literally the day after we rolled those contracts, EWZ started to fall. And this is like, I swear to you guys, this happens all the time. It's like always the worst time to get out of positions when it just, you just feel like you're getting hammered on it, but you try to stick with the mechanics, right? Everyone who got out of the position on that day literally exited at the worst possible time. If you were impatient, if you didn't have the patience to keep up with it, if you didn't take the time to understand what was going on and just threw in the towel, you literally exited at the worst possible time, because for the next 8 days, EWZ started to fall and started to fall pretty much every day after that. So what ended up happening? Well, after the initial fall in EWZ, we were then able to close our 35 straddles for December and buy those back for $5.25. Now remember, we had just rolled these positions a couple days earlier when EWZ was trading higher, but when we were able to close these back, and we closed these contracts on 11/9, so just about 7 days after that, on 11/9, EWZ was trading at 38, roughly like 39 or so when we closed those positions. So remember, our blended break-even point on the 35 straddles was 41.21. We finally got that move down to around 39-ish, and so that, boom, freed up our 35 straddles to close, and we bought back those contracts again for a $5.25 debit. Now remember, our total credits that we had collected were $6.21. So we actually closed this thing for a profit after all adjustments and after EWZ had a massive move against those contracts. But after that, we were still left with the 33 straddle. So what do? Well, we just continued to hold and be patient and hope that we could see some, again, more cyclicality come into play here. So we wanted to let the probabilities work themselves out. We knew where our blended break-even point was. So we continued to hold the 33 straddles, and we held those until 11/26. So we held them for another couple of weeks until we saw EWZ finally make a move lower. And on 11/26, it started to break down from its top and traded all the way down to 37.29 intraday. And at that point, we were able to then exit the position on our 33 straddles for December, and we bought those 33 straddles back for $4.94. And that's, again, all 4 contracts. So all 4 contracts were bought back for $4.94. So once we had everything in place, again, remember, the 33 straddles, our blended total credits that we had collected were $5.81. We bought back those contracts, all 4 of them, for an average price of $4.94. And so that means that, again, with just a little bit of patience, a little bit of mechanical rolling and adjustment for these straddles to continue to take in a credit, we actually closed both of these sets of straddles for profits and made really good money on the entire EWZ position. Now, when you go back and you total up everything that we did, all of the credits that we collected, and then subtract out all of the debits that we paid, we were left with a $540 profit overall on these 2 series of short straddles in EWZ. That is a really, really cool case study. If you don't understand how cool this is to be able to use an option strategy that you enter and then the stock goes completely against you, and if you are smart about how you adjust and how you keep the mechanics in place so that you can extend duration, we took a trade that literally was a multi-$100 loser. Not only did we just turn it around to become a winner, but we gave ourselves enough time to actually see a pretty decent profit on these contracts overall. So it's a really cool case study of how you can use options trading the right way in a smart, mechanical, systematic approach to make profits. This is not like, this is, like to me, when people say, oh, options trading is a zero sum game because when it goes against you, you're going to lose all this money. Well, if it goes against you and you lose all that money, that could happen if you do nothing. If you just let the position go and just throw in the towel and give up your hands, put your hands up. But there's so many things that you can do to reduce risk, extend duration, keep yourself small, that give you an opportunity, just a shot to turn things around. And it's not always going to happen this way. We've talked about case studies where we've reduced risk along the way and we still lost money. But man, if you can take a $700 loser and turn it into a $100 loser, or even turn it around into a profitable trade, that to me is what trading is all about. That to me is how you take, a zero-sum game that everyone think options trading is and flip it up on its head and turn it into something that you can do profitably long-term in the future. So again, hopefully you guys enjoyed this little case study. You can check out all of the stuff that we have posted for the show notes over at optionalpha.com/show151. Again, that's just the number 151, optionalpha.com/show151. All right. So before we get into the trader Q&A segment, I wanted to, like I've been doing every single week, read a quick testimonial and give a shout out to one of our members in our community who recently left a review for us. And today's review comes from Matthew Paul, who said this. He said, Option Alpha is the go-to resource for options education. I learned about options trading from the website, have found it vastly more informative and comprehensible than other sites out there. The podcast is top-notch and covers the basics from the earliest episodes onwards and gets even into more advanced topics. Without this work, I would believe it would take much longer to learn how to trade options. And I also use Option Alpha's watch list to find high IV trades. So again, thank you, Matthew. I really appreciate it. As always, super, super humbled by your guys' comments. I do this because I want you guys to know I read these, I take them all in, I digest them, I take criticism, all the feedback, all the suggestions, absolutely with a grain of salt and with an open mind on everything. So we're trying to make Option Alpha absolutely the best go-to resource out there. So again, if you have found any value in the podcast, please help us out. Get on over to iTunes or Google or wherever you listen to the podcast and leave us a rating and a review. It's definitely the best way to get the word out about what we're trying to do here at Option Alpha.
And now our favorite part of the show, Trader Q&A, where we ask a question from one of our current members about options trading. Got a question you'd like to ask Kirk to answer live on the air? Just head on over to optionalpha.com/ask and hit the record button to leave a message. That's optionalpha.com/ask. And now, here's today's question.
Hi, Kirk. My name is Andy from Massachusetts, and I just started my first option trades this week. I'm interested in keeping a trade journal designed for options. Do you have any recommendations for Excel templates that are free or paid templates like Trading Journal Spreadsheet? Thanks, Kirk.
All right. Hey, Andy, thank you so much for submitting the question. And I thought this one was relevant for today's show because as you guys were probably listening to the show, you probably thought to yourself, how in the world do you keep track of all this stuff? What do you do? What do you use? Are there any recommendations or templates? Well, I'm going to point you to a couple different things, and then we'll talk about what we're doing here at Option Alpha to help kind of alleviate this pain point, which I know for sure is a big pain point for everybody. There's one thing that you can do, and that's you can definitely just use a scratch pad of paper. So for me, and I will just say, listen, this is my scratch pad of paper that I'm pounding on right now while doing the podcast. So whenever I make an adjustment to a position right now, what I will do is I'll just write down the ticker symbol, the original credit, and then I will add or subtract all of the additional credits. Now, to me, this is really easy because I don't increase my position size, so there's no confusion on, oh, well, how many contracts was it? Did I do a bigger position size? Did I widen the wings? Did I do any of that? Nope, I keep it very simple. So in this case with EWZ, I would just write EWZ 33 straddles, initial credit 390 plus 117 plus 51 for all the additional credits. And then I know where I stand. Very easy to do, very simple. Yes, it's old school. I mean, I get that. It's not some newfangled technology, but it gets the job done. You could definitely use Excel templates. There's a lot of guys that have posted Excel templates and what they use inside of our forum. So if you head on over to optionalpha.com and search for the forum, you can see in there a lot of our members are sharing their Excel templates back and forth. I would say that would probably be the best place to see if you can get any free template that you can modify. I'm not a fan of other paid services that do it, only because we are going to be releasing, as part of the new platform that we're rolling out for auto trading, a trade analyzer or a portfolio analyzer that does all of this for you. So many of you guys are probably familiar with services like Wingman that kind of pull in all of your stats and then allow you to group and sort, etc. Well, we've already built that before, and you don't have to download any Excel files. You don't have to upload any CSV files. All you're going to be able to do once it rolls out is literally just sync up your account with TD Ameritrade and with Thinkorswim. It pulls down your history. You can associate, sort, ungroup, group trades together so that you can keep everything kind of neat and tidy. And then it'll give you performance metrics on all of that stuff that you've done. So it'll show you your win rates and which strategies are working better, your Sharpe ratios, everything kind of in one place. Now we're going to be releasing that totally 100% free because I think it's a great tool and I think everybody should have it. And so that's a value add that we're going to be giving to the community once that goes live. So if you want to hold off on, getting any of these journals or Excels working, we're going to have a great solution for you. And once we roll it out, we definitely welcome feedback on how we can improve it. So hopefully this helps out. Again, Andy, thank you so much for submitting your question. If you want to get your question answered here on the podcast or live on Facebook, as I've been doing every single week, please head on over to optionalpha.com/ask, just like Andy did, and click the big red button in the middle of the screen and leave me a private voicemail. Again, there's no software to download or install. It's very easy to do. You can do it in 30 seconds, a minute. Just ask your question and we'll get it queued up here for the closing bell and Trader Q&A segment.
Now, the closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
All right, so in today's closing bell segment, I want to go through a new trade that we're getting into in GDX. Yes, GDX is the gold miners ETF. We've actually traded GDX fairly profitably over the last couple months and haven't had a position in it in the last couple weeks, but with implied volatility still being generally high, we're going to get into a position here in GDX and get some exposure to precious metals generally, which we don't have in our portfolio. Right now, implied volatility is around the 64th rank in GDX, so again, fairly high. And what we're going to do is we're going to do the Straddle synthetic, which is just a fancy way for me to say we're going to do the iron butterfly, which is a favorite strategy of ours. Basically selling the 20 at the money straddle in GDX, so selling the 20 calls, selling the 20 puts, which is where GDX is trading right now, and then buying wings out on either end by $3. So buying the 23 calls and buying the 17 puts for very, very cheap. Now, generally, I would do these positions like GDX as a pure straddle. But in this case, with GDX, even though implied volatility is high, for some reason, the outside wings are insanely cheap. And we don't often see this when implied volatility is high. Usually you collect a high premium and the outside wings or the outside strikes on the option chain are still pretty high in price as well. But with GDX, for some reason, I don't think people expect it to move that much, even though implied volatility is pricing in a pretty decent move. And so the outside wings are very cheap. You can buy the 23 calls for 6 cents. You can buy the 17 puts for 3 cents. It's a no-brainer to me to add this to our position to create defined risk because it's cheap risk. It's basically like buying insurance for almost like pennies on the dollar. So again, we're doing the iron butterfly trade. It's more like a straddle synthetic with just very cheap protection, but it keeps everything neat and tidy and it keeps our margin contained. We don't have any exposure to increasing margin in GDX. And of course, it's a small position, 3 contracts for now to start, and we'll look to add more contracts if GDX continues to move.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, so I hope you guys truly enjoyed today's show, as always, and got at least one thing out of it that you can apply right now to make you a smarter, more profitable trader and investor. As always, you can get additional resources, links mentioned in the show, and some related video courses from today's show by going to optionalpha.com/show151. Again, that's just the number 151, optionalpha.com/show151. Until next time, happy trading.